Hello everyone, welcome to this channel. I am Joseph. Thank you for joining me here. Before I begin, please feel free to subscribe and share this channel with your friends and colleagues. And also do remember to switch on the notification button so that you will receive the latest e-learning videos seamlessly. Today, we're diving into a critical yet often complex area of financial auditing, Asset Liability Management, or ALM. In the wake of recent bank failures and interest rate shocks, the audit of ALM has moved from a technical exercise to a cornerstone of strategic risk assurance. Now, I'll provide you with a clear framework for conducting a robust ALM audit. We'll start by understanding why ALM auditing is so crucial today. Then, we'll establish a foundation of core ALM concepts and risks. The heart of our talk will be a practical, 5-phase audit methodology you can apply. We'll conclude with key takeaways and a look at emerging challenges. Let's be clear. ALM is not just about regulatory tick boxes. It's the discipline that ensures an institution can meet its obligations, remain profitable, and survive under stress. Recent history is our teacher. The sudden rise in interest rates exposed fatal flaws in ALM practices at some institutions. Mismatches in duration, over-reliance on unstable funding, and inadequate stress testing. As auditors, our role is to move beyond historical accuracy and ask, is the balance sheet structured to withstand tomorrow's shocks? Our audit provides assurance on liquidity survival, interest rate resilience, and strategic decision-making. Every effective ALM framework rests on 3 pillars. First, governance. A strong ALCO, the Asset Liability Committee, clear policies and defined roles. Second, measurement. How do we quantify risk? Primarily through interest rate risk metrics like net interest income simulation and economic value of equity sensitivity, and liquidity risk metrics like the LCR and NSFR. Third, limits and controls. Tolerances set by the board for these risks, and the controls to keep within them. Your audit will test all 3. Our audit focus targets these interconnected risks. Interest rate risk, the risk that changes in rates hurt earnings or economic value. Liquidity risk, the inability to meet cash flow obligations. Crucially, we must audit behavioral risk, how management assumes customers will behave with deposits or loans in a crisis. These behavioral assumptions feed into model risk, perhaps the most critical area for us as auditors. Are the models and their assumptions valid, documented, and challenged? Now, let's get practical. Here is a 5-phase methodology to structure your ALM audit. This is a risk-based approach, meaning we spend the most time on the areas of highest inherent risk. Phase 1 is diagnostic. We ask, what is the entity's business model? A retail bank's ALM risks differ vastly from a capital markets firm. We identify material balance sheet items, those large or complex deposits, loan portfolios, and wholesale funding. We learn from history. What did last year's audit or the regulator's exam find? This phase sets our strategic focus. Here, we test the framework's backbone. We attend an ALCO meeting or review its minutes. Is it a true decision-making body or a reporting ritual? We scrutinize the ALM policy. Is it updated for current risks? We trace limit breaches. Are they merely reported, or are they investigated with remedial actions? Weak governance here is a critical finding. This is often where the audit finds its most material issues. The most sophisticated model is worthless with bad data. We must perform substantive testing on data flows. Then, we focus on model risk. We don't revalidate the model, but we must review the independent validation report. We critically challenge management's key behavioral assumptions. For example, in a high-rate environment, are non-maturity deposits still assumed to be sticky? We test the sensitivity of results to changes in these assumptions. Now we independently verify outcomes. We might reperform a simplified NII shock calculation. We reconcile liquidity metrics to official regulatory filings. A key area is stress testing and ICAAP, the Internal Capital Adequacy Assessment process. We evaluate, are the scenarios severe enough? Are the management actions in a crisis plan realistic and executable? This is where we move from checking math to assessing judgment. Our final phase is about impact. We report not just that a limit was breached, but why. Was it a data issue, a poor assumption, or a lack of hedging? We prioritize. A model flaw is catastrophic. A reporting delay is operational. Our recommendations should be constructive, aiming to strengthen the ALM framework. We tailor our communication. Technical details for ALCO, strategic implications for the Audit Committee and Board. Let's recap your toolkit. First, ALM audit is a strategic assurance. Second, remember that your most valuable skill is skepticism towards assumptions. Dig into them. Third, apply the structured methodology. Plan, assess governance, validate data and models, test substantiatively, and report for impact. Looking ahead, our ALM audit scope must evolve. Climate risk is becoming an ALM issue. How will a carbon tax affect industrial loan books? AI and machine learning are creating new, complex models we must learn to challenge. Digital assets introduce novel volatility. The core principles remain, but the subject matter is expanding rapidly. To conclude, auditing ALM is about ensuring that an institution truly understands its balance sheet risks and is resilient against the unknown. It's one of the most value-added audits we can perform. Thank you for your time, and if you found this channel is useful, please feel free to subscribe and share it out with your friends and colleagues. Thank you, and have a great day ahead. Hello, everyone.